Today we are going to talk about computing variances in budgeting. You may not always earn or save what you plan on. You then have a difference or a variance for either your income and savings or your expenses. First, we're going to talk about income and savings. If you earn or save more than what you expected, you have a favorable variance, meaning that you have more money to save for the future, or you have some money left over that you can then put into savings or to buy something else. If the variance is unfavorable, meaning that you earn or save less than expected, then you have to figure out what you're going to do in order to meet all of your expenses. Let's go ahead and practice this. So today we have an actual income. We earned $500 from our job. We had budgeted that we were going to earn $400. So first we're going to subtract the budgeted income amount from the actual income. So that would be 500 minus 400, which gives us $100. Now, if you look at this, you'll see that we actually earned more than what we had budgeted, $100 more. If the actual income is over budget, the result is favorable. So we would label that with an F, or favorable. If the actual income would have been under our budgeted, the result would be unfavorable and we would not have enough money to pay all of our bills. The next step is to divide the difference that we found by the original budgeted amount. So we found that we had $100, and that's a positive. We had $100 more than what we planned. Divide that by $400. Okay, 100 divided by 400 is 0.25. The last step you'll see is to multiply the result by 100 to get the percentage over budget. So we're going to multiply by 100, and that gives us 25%. So our budget variance in this example is 25% favorable variance for our income. Now we are going to talk about variance for expenses. Okay, so this is kind of a reverse response to the way we responded to our income. So if you have more expenses than what you planned, okay, that would be unfavorable. You're spending more than what you planned. If you spend less than what you planned, then you would call that a favorable variance. So you want to spend less than what you budget for. And remember, a budget is created at the beginning of a specific time period, such as a month or a year. So let's go ahead and practice this. So we see that we actually spent $50 and our budgeted amount was $40. So we are first going to subtract the budgeted amount from our actual expenses. So that would be $50 minus $40, which gives us $10. Sounds easy enough. So we actually spent $10 more than what we planned on spending. So if you look at the green box, you'll see that if the expense was over budget, the result is unfavorable. If the expense is under budget, the result will be favorable. So in this case, the expense was over what we planned, so this would be considered unfavorable. $10 unfavorable. The next step is to divide the difference by the original budgeted amount. So our difference is $10. Our budgeted amount is $40, which gives us 0.25. In order to find the percent variance, we need to multiply by 100 to give us 25% unfavorable variance. That's all for today, so let's go ahead and practice in ClassKick. Open up your ClassKick app now and calculate the variances on your own.